Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar where we'll be discussing portfolio optimization for equities. We're very pleased to have one of our research providers deliver today's presentation. So please join me in welcoming Economatica and Emery Ventura, the Senior Product Manager for Economatica, for today's presentation. Now, before I do pass the controls over to you, Emery, what I do want to do is bring up your title slide that does include information on how you'll be able to contact Emery after today's event if you do have any further comments or questions. So with that, I'm going to pass the controls over to you, Emery. If you would go ahead and share your screen, let me make you the presenter first. If you can share your screen, let's get underway here today. Thanks for joining us, Emery.
Thank you, Cynthia. Appreciate that. Good afternoon, everyone. Welcome to our webinar. Is my screen showing? Can you confirm, Cynthia?
Now it is. Now we're able to see it. Thank you.
Wonderful. Thank you all. Again, thanks for joining us. We're here to discuss portfolio optimization. And to do this, we're going to use our own proprietary interface that we've developed here at Economatica, which is based on the classical model that was introduced in the 1950s by Harry Markowitz. Some of you may be aware. He wrote an essay back in 1952. And years later, he actually earned the Nobel Prize for his work. So this is really important work. It's used today by many asset managers around the world, and and this is what we are going to be reviewing in this session. So I'm going to go here and the main menu and choose portfolio optimization. Okay, so some of you may be aware, the object of portfolio optimization is essentially for a given set of stocks, a given level of risk, we want to maximize the expected return. That would be the definition of an optimal portfolio. How do we find optimal portfolios? And to do that, there are basically four key elements. Number one, we need a universe of stocks of interest. So this would be submitted by you. What are the stocks that you're interested in? And our optimizer will work over that group of stocks. Number two, expected returns. And to obtain expected returns, you will see that we will use target prices. Number three is risk, okay, which is essentially volatility. And number four, a correlations matrix. So these are the elements that are needed in order for us to perform portfolio optimization. The first two are driven by us. We need to define the set of stocks, and we need to define our target prices. So in order to do that, and for the sake of this presentation, I have already I'm copying some ticker symbols, some stocks that I've previously compiled. So essentially, we're looking at the largest market cap companies in the U.S. That's the list here that has populated in front of us. Again, this will be your own list. If you have your own set of stocks, you can import them into this module. Okay. Next, the second element, as we discussed, is to come up with expected return, which is, if you note here on the screen, it's this column here. To arrive at expected return, we are going to submit target prices. If you've done your research, if you work with brokers perhaps, you might have compiled your list of target prices. Yeah? Or maybe you have your own models in Excel where you have expectations for these stocks. If you note on the upper right corner here, these target prices are a year out. Okay, so this would be for June 2020. Okay. You would go down this list and just enter your target prices. Okay. However, again, to make it simple and for the sake of this presentation, I'm going to use a feature that's built into our platform here, which is let's arrive at target prices using the average historical returns. In other words, let's assume that the past performance will be, we'll use it going forward. It will be the same behavior for the next 12 months. Let's hit OK here, and the platform will derive those target prices, and here they are. So assuming the performance over the last 12 months, let's assume the same behavior going forward, and these are the target prices that we have populated. Ideally, you would have your own target prices, perhaps from analysts that you work with, and you would be submitting those instead, okay? In this screen, once we have target prices, you can see that the system has now calculated expected return, has calculated risk, or that volatility we talked about earlier, and tracking error, okay? Down below, you can see that for the risk-free, which is an essential component that will be used later on, we're using the 10-year Treasury bond of the U.S., okay? So this is this initial step, and if you notice on the top here, we call this expected value. So we have submitted our universe of stocks, and we have also submitted our target prices, okay? Those are the first two inputs required, as we discussed earlier. Let's move on to the next section here, which is correlations. Okay, the correlations are populated automatically by the platform. So for this universe of stocks, we're looking at a 36-month period of correlations. So if I want to see how, for instance, here Intel is correlated to Microsoft, it's right here on the top, 57%. How is Walmart correlated to Salesforce? 30%. Okay. So this is another key part of portfolio optimization, okay, correlations. The period can be adjusted. If we go up here, you'll notice this is the 36-month we talked about, and it's platform using daily observations to perform these calculations. We can change this period. Anything over 36 months, platform starts using weekly observations, okay? Okay, if we scroll over to the next option here, after correlations, we come to optimization. And this is where our platform plots the efficient frontier, which is really the heart of portfolio optimization, the efficient frontier. As you can note, the point that's blinking corresponds to the lowest risk. This x-axis here is the risk, or the volatility, and our y-axis here is the return, expected return. So this is the point of lowest risk, and of course, the lower the risk, the lower the return, so that would be also our lowest return. The point highlighted corresponds to these weights that we see on the left-hand side here. Okay, so 31.8%, that would be our largest holding in this portfolio, right? Xterra Energy. And then you go down, second largest would be Walt Disney. As you climb up, in other words, as an investor, you're saying, I'm willing to take on more risk for a higher return. As I click on other points on the efficient frontier or other optimal portfolios, we can see how we're climbing the ladder, and we're asking for higher expected returns and assuming more risk. Markowitz theory tells us that if we click on the rightmost point of the curve, meaning assuming the highest risk to achieve the highest return, we're allocating all of our assets to one stock. Okay? If we revisit our expected values, we notice here we have NVIDIA. If we go back to expected values, that initial screen we started with, and we sort by expected return, notice NVIDIA is right on the top. So we're saying if we want to have the highest potential return, assume the highest risk, we're putting all of our assets into one stock. In this case, NVIDIA. Okay. Now, we have some graphical components to the platform here. If we go to modify graph, select, for instance, the sector, we can get a snapshot of the sector for any given portfolio based, let's click on one of these optimal portfolios here, and you'll notice this line coming across. That's the sector composition. So we can see, in this case, for instance, this brown portion at the bottom, electric power, is 31% of our portfolio. Okay. As we click on other points on the curve, it moves along the color-coded graph. Let's go back. To our original chart. Okay, before we go on for 1 second, we have a question. Is it possible to have target prices based on historical valuations? Well, yes, you can. Again, you are submitting these target prices. So if you can bring in any target prices based on any valuation metric that you wish to use. For example, I won't go too much into it. There's a DCF model that's part of our platform too. You can derive target prices that way. So how do you derive the target prices? You can use a variety of different ways, and yes, certainly you can use any of those methods. Okay, I'm going to continue. I see some other questions. I welcome questions. I'd love to see questions. I'll answer them as they go along, and then we'll group some of them at the end as well and come back to answer them. Okay. Let's go to the next option here across the top, which is constraints. Constraints is key, right? So we're looking at a blue efficient frontier at the moment, that curve that we're just examining, and as you can tell, we're saying that every security we can go from 0 to 100 weight. So that's a long-only portfolio, basically. You can adjust these weights on the security level. For instance, you might want to say, I don't want any particular security or stock to be over 20% or over 25% of the overall portfolio. You can specify those constraints in here. I'm going to go to the red side here, which is where it's labeled red, and I'm going to create a second efficient frontier in which I will ask that every security can go from minus 10% to 10%. Okay. So now we're not just asking for long-only portfolios. Now we're allowing for shorts as well. Let's return to the optimization screen, and let's see what this curve looks like. While that gets plotted, we'll continue with the questions. See, Rodrigo is asking, I can see that you can also use the CAPM. Yes, that's correct. Really briefly, if we go back to expected values, that was a good catch. When we derive target prices, use the average historical returns option, you can also obtain them using the CAPM model. The other option that I mentioned before is the DCF model. That's discounted cash flow. We have a way for you to build discounted cash flow models for the individual stocks, and you can derive target prices that way as well. And thank you for your questions. Let's go back to optimization. Now we have this red frontier, which you'll note that if I click on them, notice right now we're clicking on the blue, and we just show only the stocks that have weight. Okay, so if I click on any of these blue, right, we have only long-only positions. If we go to a red portfolio, now the weights cannot exceed 10% per our constraint, and the weights cannot go under negative 10%, as you can see here. Okay, so this is, you have less options here because we have constraint. This red efficient frontier from minus 10 to plus 10. Very good. So you can create as many constraints as you can. For example, let's go back to constraints. Here we created the individual weights for each security. Okay. If we scroll down, you'll notice we can specify other types of constraints. For instance, sector. If we don't want to be in the finance sector, you can say 0% in finance. Okay. If I want to constrain based on other variables not shown here, the platform also allows you to do that. Let's go back to expected values. For example, one popular variable used is market capitalization. Perhaps you want to constrain your portfolios based on market cap, not to exceed a certain size, or if you don't want the small cap companies, you can specify that criteria. How do we do that? We use this option, create a column here, and we're going to insert those variables. Add market capitalization here. Okay. Another popular constraint would be dividend yield. Add dividend yield here too. Okay. And notice that as I bring these variables, market cap, dividend yield, and we come back to constraints, go all the way down. Okay, it has opened up a whole new level of constraints, market capitalization and dividend yield. Okay. It uses by default the median value to separate it, but you can also create your own segments as well. Okay, so you can constrain based on any variable. There are hundreds and hundreds of variables available for you to specify your constraints per your requirements. Another important aspect of this is, go back. I'm gonna just for the moment let's go back to optimization. Go back to the graph. We looked at this earlier. For optimization, we have two functions: risk return, which is what we're looking at right now. You can also optimize based on tracking error, active return. Active return, it's the excess return over the benchmark, and then of course tracking error as well. So in that case, we're looking at a benchmark. We want to beat the benchmark, and also looking at risk relative to the benchmark. So that's available through this option here: tracking error and active return. We can also plot the Sharpe. Okay, let's hit OK here, for instance, Sharpe. Here's the Sharpe. Okay, so if we want to find the optimal portfolio based on having the highest Sharpe, that would be this one here. Okay, so this portfolio that's highlighted at the moment, I clicked on the highest point in the curve, my Sharpe curve, and it corresponds to this portfolio, which has a risk of, as you can see, 12% and an expected return of 31%. Okay. So by definition, this is the optimal portfolio with the highest potential Sharpe. Speaking of portfolios, that brings me to this section here, portfolios. The whole objective of performing portfolio optimization is so that you come in here and you create your portfolios, whether they're your actual real portfolios or hypothetical portfolios that you want to examine. The platform allows you to do that, and then we can see how these portfolios, where they lie relative to the efficient frontier. So what I'm going to do here, quite simply, is just enter some arbitrary figures to create a portfolio. Notice this portfolio is labeled A for now, and let's start adding some values. Add here 1,000, put 800 here, 750 here. You'll note as I enter these values, the system is populating on the right-hand side all these key indicators for the portfolio. Okay, and let's say this is my portfolio, and these are all my metrics. This is about VAR, Sharpe, risk, return. All these key ratios are indicated. Let's return to optimization, and let's see where A is. Okay, so here it is. So now we have our efficient frontiers, and now we know where our portfolio A lies with respect to our efficient frontier. And the first thing you'll notice, which is really what we're trying to do with portfolio optimization, is that for this level of risk, which is around 15, right, we have much better option here, which is the optimal portfolio. For the same level of risk, if we're only doing long only, which is the blue curve, we can achieve a 35.8% return. Right? So this would be going from A, again, which is only a 22% return, to a 35, or nearly a 36% return if we optimize. There are two ways to optimize. There are various ways to optimize. What you do is you right-click here, and we tell the system we want to optimize. Okay. You might be injecting more capital. If you are, the system will give you the operations required to invest the capital and get to an optimized portfolio. You might be taking capital out of your portfolio. If you're taking capital out, again, we want those suggestions as to how to keep our portfolio optimized. Or simply, I just want to reach the frontier. Okay, so I want to rebalance my portfolio and optimize it. So I clicked on reach the frontier. System is calculating. Okay. Okay, it's populating now. And let's select one of these points. Okay, you'll see here on the left side the trades, right? These are the operations that would be required to go from A to the optimal portfolio. Okay, and the right-hand column would be our newly constructed optimized portfolio. Okay, so we have the original portfolio on the left. We have the operations required to take us to an optimal portfolio on the right-hand side. Okay, system is still performing some calculations while these suggestions are presented. Okay. You realize there's a lot of mathematical operations taking place behind the scenes here. There we go. Okay, it continues to populate. Okay. One moment, please. I think might be having an issue with the internet connection. One moment, should be repopulating any moment now. Please bear with me. While this recovers, we seem to have a connectivity issue here. I'm going to bring it back up. Can I take more questions in the meantime? I see net debt to EBITDA. Yes, I'm assuming you're asking if we can use net debt to EBITDA as a constraint variable, and the answer is yes, absolutely. You can. Let me just log back in here. And Rodrigo is asking about the Black Litterman approach. We don't support Black Litterman at the moment. Thank you. Thanks, Rodrigo, and thank you all for your questions. bring up the system here. Okay, we should be logging back in. It looks like there was just an interruption in the connectivity. We're using a cloud-based platform. It sits on the cloud, and so the advantage is obviously you can reach this platform anywhere where you have access to the internet. But unfortunately, if there's an issue with the internet, you can lose connectivity momentarily. Okay, this should be okay. We're coming back. Okay, so this is as you can see, when this when there's an interruption, it brings you back to where you were, and as we were saying, these would be the operations required to get you to an optimal portfolio. You can also click on any different points on the curve, and any of these you can simply right-click and save it. When you can save it. So, for instance, if I like this portfolio here. This would be portfolio B, okay, and there it is, portfolio B. And you can save a number of different portfolios with the ideal optimal weights shown on the right-hand side. With regard to the question about net debt to EBITDA, you would go back to here, expected values, as we did for market capitalization and dividend yield. Certainly, you can create a column. Okay. Okay, and here's your net debt to EBITDA variable. Okay, you can bring it in here. Now that it's here, we can go back to constraints. Okay, and this should be now an option here. Okay, here's your net debt to EBITDA shown as one of your constraint variables. Now, of course, you can now put in the constraint values that you're interested in. Okay, we have another question. Okay. Yes, I think you've answered your own question, Rodrigo, about if we can use other fundamental metric as constraints. In your case, return over equity. Yes. All these variables are available on the platform, and any variable that's part of our database you can use as a constraint measure. So yes, the answer is yes, you can. Yes, you can. Very good. So again, sorry for the interruption there in the connectivity, but I think you get a sense of how portfolio optimization can be performed on our platform. We've simplified the process of what could be a very complex issue, arriving at an efficient frontier, specifying constraints on hundreds of metrics in a very easy to use interface. Okay. Again, the only requirement from you is to inform the system what is the universe that you're interested in terms of stocks, your eligible universe of stocks, and your target prices, unless you want the system to derive those target prices. Once you do those two things, the system generates the correlations matrix, calculates the risk, and generates the efficient frontier. Matthias, is there integration with Interactive Brokers? Of course, the platform is available on Interactive Brokers. There's no in terms of trading. There's no on placing orders. There's no integration in place. Obviously, Interactive Brokers is an important partner, and Economatica is the resource that's available on their platform. But there's no live integration as far as placing orders. This system can give you the suggestions, and then of course you can go ahead and perform those operations directly with Interactive Brokers. Thank you, Matthias, for your question. Okay, I see that. Any other questions? I see, Michael, number of stocks that are supported by the optimizer. That's a good question. We have run tests with literally hundreds of stocks, and I know that's an issue when you're using Excel and other platforms that they can easily, because of the mathematical computations behind it, they grow exponentially. They don't support a very high number of stocks, but we've run tests with hundreds and hundreds of stocks. We've dropped in the S&P 500 constituents in here. It performs very well. So yes, it can support a very large number of equities. Can you perform back tests of the portfolio selected? Yep, good question. We do. We have our Economatica overall has various different modules, all integrated. Portfolio optimization is one of them. We have others, and there's one in particular that allows you to perform back testing. So yes, you are able to do that on this platform as well. Do we need to import the data? Thank you, Jonathan. That's another a very good question. It's all integrated. All of the data, all the pricing historical data, all the daily updates are part of the platform, part of Economatica's database. So all you really need is a set of tickers and target prices. Everything else is part of the system. It's integrated. So no, you don't need to import actual equity data to operate this module. Any other questions?
Well, Emery, while we're waiting for any additional questions, what I'd like to do is grab the controls and show folks how they can access your information from the Interactive Brokers website. So let me grab those controls, and I'll send them back to you in just a moment here. And by the way, everyone, if you do have a question, remember there's a questions panel that's located on the right-hand side of your screen. Simply double-click that title bar and enter any questions or comments that you may have. So for right now, what I am going to do is come back into my platform here, and let me bring you to the Interactive Brokers website. Actually have it open on my separate screen, so I'm going to bring that. Let me see here. Go ahead and bring this one. Here we go. So how would you access Economatica from the Interactive Brokers platform? Now, I do want to point out, notice that from our website, there's a pricing menu where you can access the research, news, and market data information. Now, here I am on the research page, and do want you to see that we do have several different products that are available. Now, what I'm going to do is simply scroll down here and locate Economatica, which happens to be alphabetically sorted. Now, notice here we do have the Economatica. Hold on a moment, I spoke too fast. I did want to point out on that previous page, let's go back here. Notice there is a free trial. If you'd like to give Economatica a start, we do provide you with a 30-day free trial period. So, and you'll also be able to see the subscription charges. But I do want to point out, beyond the description, there's a link here to learn more. And also notice that this happens to be a third-party tool. So while it's available, you will be brought to a separate login screen as we just saw Emery go through. Now notice that Learn More button here will give you access to some additional information and even get you out to that website as well. So I did want to point out that it is available through Interactive Brokers. So with that, I'm going to pass this back over to Emery. So Emery, I'm going to pass you those controls. You will have to share your screen once again. And if there are any additional questions, let's go ahead and handle those now.
Okay, thank you, Cynthia. Thank you for that. Any other questions? As Cynthia pointed out, you have access to a free trial. You can test out the tool on your own if you think that's something you want to do. Of course, while you're doing that, you will have all of our support in terms of answering any additional questions or putting into practice portfolio optimization with your own portfolio. So feel free to take advantage of that if that's something you want to do. And in the starting slide, you have my email address. I believe I've answered the questions that have come up so far, looking at them now. But if anything else comes to mind as you review the video or the slides that Cynthia will share with you, please feel free to reach out to me directly with any additional questions. Is that it? I believe that's it, Cynthia. I think I'm not seeing any more questions coming in.
I had my phone on mute there for a moment. So that is going to conclude our session today. And I want to thank Emery for today's presentation. And you'll see that I do have access or have put up the slide that does have contact information. If you do have any further questions or would like to discuss Economatica, please contact Emery with the information that we've provided here. Also want to let you know that we have been recording today's event, and each of you will get a direct link to today's recorded playback, as well as access to some representative slides that Emery has prepared for us. You'll see these slides as well as based on what Emery's discussion was on today, and the contact information will be available. So if you do want to come back and review those concepts, simply watch your inbox later on this afternoon. So with that, we are going to conclude our session. I want to thank all of you for joining us here today. We do appreciate your time as well. You can exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone, and thanks so much for participating.
Thank you, everyone.